people out of business. What do you think about that? Give me some sort of answer. Do you think anything about our tariff policy? Don't you feel you have a responsibility here? Are you afraid of President Donald Trump? Why don't you deal with this? Because our economy are suffering in a mighty bad way. And I've got to represent my constituency. And they are, let's take Georgia's agricultural sector, mostly pecans and poultry and cotton exports. They've been hit hard by retaliatory tariffs from key trading partners like China. Why are you running away from the tariff fight? Give us some understanding of that.
Honestly, this is just not our role. We are not a an institution that comments on or analyzes decisions that the president makes, or the things that he runs for office on and is elected on and then does. We don't. That's just completely out of our lane. It's really inappropriate for me to have any comment on that. I'm sorry to say, Mr. Scott.
We're having these regional disruptions. Our economy is in a bad way. And I want to see you and the president. You got to get together on this. We got pecans in Georgia. We got peanuts. We run the biggest group. We got the fastest growing trade mechanism in the Savannah Port Authority. We're crushed in Georgia. My business folks are coming to me on it. I got to get some answers from you. What do I tell them that the Fed chairman feels about their experience in this tariff? I think we need to get you and the president together.
Gentleman's time has expired. Appreciate the gentleman from Georgia. The gentlewoman from Florida, Ms. Salazar, is recognized for 5 minutes.
Hi, thank you very much for being here. Appreciate your time. And my name is Maria Salazar. I represent the city of Miami, which is one of the cities most composed of Hispanic Americans and people that adore living the American dream. So putting that into context, I wanted to ask you a few questions about the labor force. We agree with what the President Trump is doing, or what the administration is doing in deporting illegals, criminal illegals. We do not want Trenderagua. We don't really want people who have committed any type of crime, even more if they're illegals. And but we do know that unfortunately what's happening right now after 6 months of being Mr. President being in office, that we're losing thousands and thousands of workers, what the ICE leadership has called collateral damage. And most of those people are working in three main sectors: construction, hospitality, and agricultural. Even the president said the other day in a tweet that he understands that those hands are needed. We're talking about 15% of the economy: construction, hospitality, and agricultural. So my question to you is, what is the growth effect on the economy if this type of removal of people, of hands being removed from those three main top sectors?
So immigration is another area where nobody put us in charge. We're not, Congressional Budget Office and other agencies can make assessments like that. We do have a role to maximize employment, but we take immigration policy we take it as it comes. What it's obviously done is it's really reduced the amount of growth in the labor force. And so at the same time, demand for workers has been coming down as well. Because they've been coming down at about the
one
same.
Drop at a time. Reduce the growth. Why don't we talk a little bit more? Because we want to continue growing. We're the #1 economy in the world. We need to continue growing. So you're saying that What's affecting the growth?
Well, there are two things that affect growth. One is growth in the labor force, more people working, and the other thing is productivity. How much do they produce per hour worked? And when you significantly slow the growth of the labor force, you will slow the growth of the economy. But I think, again, it's not for us to have a view on immigration policy.
No, I
can just
understand. It
report
was
that.
just my comment, but you do agree that if we don't have those hands, then we don't grow.
I think that growth will slow, and actually is slowing this year, and that's one of the reasons.
Well, we don't like that. So now let's talk about of the next 10 years, 2025 to 2035. Americans are not having enough kids. So that means that we need other people, right? So over the next decade, based on the current trends that I just explained to you and that you just reiterated, will there be enough workers to fulfill the labor needs of our economy between 2025 and 2035?
So I think labor economists do observe the phenomenon you're talking about, which is demand for labor going to be met by the domestic population, the native-born population? And the answer appears to be probably not over the next 10 years. And
then what about if we do not have that labor force over the next 10 years? What happens?
So many things will happen. You can see a big increase in productivity, which would mean we don't need as many workers. For example, artificial intelligence could be implemented in a way that creates widespread productivity gains. I wouldn't count on that, but it's a possibility.
You would not? You would not count on that?
I wouldn't count on it.
You would not?
No, I mean, I think there'll
not?
be gains because with productivity enhancing things, they typically take longer to be implemented, and then it takes a while for the gains to be shown. I think in the case of artificial intelligence, those gains are coming, but they may take longer or be less in the beginning than expected.
And during the time that those changes happen, then what happens? Our economy doesn't grow. Is that what you're saying?
Yes, but I mean, those who make immigration policy are entitled to weigh these factors. We can report on what happens, but it's really not our job.
I understand it's not. I just want to hear what you're thinking, what's your expertise based on those immigration laws that we're implementing right now. The last one, because I only have 30 seconds. Do you think that with everything that we have talked about, do you think that we can continue remaining, or the United States economy can continue being the #1 economy in the world, and that we could compete if we were to have the immigration laws that we have right now?
I think you could have, the highest per capita earnings, but if you're talking about the aggregate output, then, population growth may be a constraint.
Now, which one of the two is more important?
Gentleman's time has expired.
Good question.
Well, you can, I think.
Gentlewoman's time has expired.
All right.
Let me turn to the ranking member of the House Intelligence Committee, Mr. Himes, for 5 minutes.
Thank you, Mr. Chairman, and welcome, Chairman Powell. Let me start by thanking you for your careful keeping in your lane and steering clear of fiscal policy, and in particular for your stalwart defense of independent monetary policy. You're getting pressure from very powerful places and lots of kibitzing from lots of members on the interest rate question, and most know better that our independent monetary policy is the very bedrock of our economy. So thank you for that. Mr. Chairman, I want to talk just a little bit about some of the technical matters associated with energy prices and inflation, because obviously turmoil in the Middle East has sent oil prices swinging wildly, with West Texas Intermediate in the last month or so being anywhere between $61 and $75 a barrel. We recently saw the Iranian parliament vote to close the Strait of Hormuz, which currently handles around 20 million barrels a day, a fifth of global demand and a little bit more in terms of natural gas. Chair Powell, you said last week that conflict in the Middle East in the 1970s resulted in very large inflation shocks. In contrast to the 1970s, today the United States does not import most of its energy. We call ourselves energy self-sufficient on a net basis. But I hear the argument made that I think is wrong, that because we're energy self-sufficient, somehow we are insulated from global energy market prices. Can you comment on that? Is there any validity to the notion that we are not, American consumers of energy are not subject to global swings in energy prices?
Yeah, so the price of oil is set globally, right? And I think if you go back a few years, the thought was that when the global, we had a natural shock absorber, which is that we would just drill more. And that we would, if prices went up, we would drill more. And so you wouldn't have these sustained price shocks that we had during the 1970s and the original OPEC era. I think that is actually in question now because, the oil industry in the U.S. is being much more careful and focused on return on investment than they were, having been burned with overcapacity.
Right, and I mean, yeah, in the long run, you can invest in additional extraction technologies, but this does not respond to day-to-day spot prices. So
not quickly.
The point
no.
I'm trying to make is that the conflict in the Middle East, if it resulted in $120 barrel oil, which is where oil was in 2022, that would have a fairly substantial inflationary impact on the American household. Is that correct?
We would certainly feel that, and as we've discussed earlier, there's a lot of lore around looking through oil price shocks, but that depends on the facts and circumstances.
What, as a technical matter, we tend to refer to CPI, which is a basket of goods, and we measure the price changes. Roughly speaking, what percentage of that basket is comprised of energy?
I don't have that on top of my head. It's much less than it was, of course. And oil consumption is much less than it was in the 70s as a percent of GDP.
But energy includes natural gas and gasoline, and it's a meaningful portion of the
yes. Although of course we have more natural gas than we have so much natural gas, so that'll always be there for us.
So none of us can predict what's going to happen in the Middle East in an hour, much less in a week or a month or a year. But as a technical matter, at what price for a barrel of oil does the American household begin to feel inflationary effects? So we're at $75 a barrel roughly right now. At what price point does the American household begin to feel some inflationary effects?
I don't want to throw out a number. I think we're frankly, it's too early to say that something like that's going to happen, and I know you know that, but I wouldn't want to throw out a specific number. If prices went up materially, people would feel that.
Okay. Again, I think if I look at the data here, WTI per barrel about $120. It peaked at about $120 in 2022. What do your models suggest would occur to inflation, and how would it influence the Fed's thinking should we be back at $120 a barrel?
Well, let's just say there's a big price spike in that range. So, we would look at that and we would ask ourselves, we look at the overall situation, we would ask ourselves, should we react to that? So, for example, during what we called the Arab Spring back in the early teens, oil prices went up a lot, and that went into the price, and there was a discussion, and I think the right answer was to look through that. The question you'd be asking to yourself, because by the time you react, the price comes back down. I think the question today would be, is the situation different, and what would be the implications of those differences?
Gentleman's time has expired. I thank the gentleman from Connecticut. Chair recognizes the gentleman from North Carolina. Mr. Moore, you're recognized for 5 minutes.
Thank you, Mr. Chairman. Chairman Powell, I want to touch on international standard-setting bodies like the Basel Committee on Banking Supervision. Their goal is to promote better harmonization for global capital flows and regulatory standards, but the Biden administration's implementation of Basel III endgame demonstrated the pitfalls when the U.S. is a follower instead of a leader in the international arena. That's why both Democrats and Republicans shot down former Vice Chair Michael Barr's proposal, which made capital less acceptable and put U.S. firms and businesses at a global disadvantage. Do you agree that the United States should only implement international standards in a way that is consistent with our own domestic legal and regulatory scheme?
I do.
I appreciate the Federal Reserve's announcement yesterday to end the use of reputational risk during banking examinations. This supervisory practice was used as a tool to pressure banks to refrain from offering financial services to politically disfavored individuals or industries. What further steps is the Federal Reserve taking to help usher in these changes, such as ending examination practices that informally encourage banks to close certain accounts without written justification?
So we're developing, I should say Vice Chair Bowman is developing a range of policies that will help in that area, and I should let her speak to it. But as you know, we've eliminated reputation risk largely in a thoughtful way from those things. I think we became more aware of that problem over the course of last year, and like the other agencies, decided to move away from that. We're very conscious of the fact that we shouldn't be telling banks who they can lend to, that's a decision for them in the private sector.
Let me ask you this, how are you ensuring, though, that like the frontline examiners are aligned with this new direction and not continuing with any past practices?
You know, I will say that is the ultimate question, is will and I think they will, and I think as a former bank examiner, Vice Chair Bowman is actually very well positioned to engage with supervisors and in a way that someone with experience can do successfully, whereas if you don't have that experience, I think it might be harder.
Thank you. You know, Secretary Bessent recently announced a drive to change the culture of supervision through improvements to examination procedures, enhanced monitoring of examiners' compliance with those procedures, and more realistic processes for appealing supervisory findings. That includes defining unsafe and unsound by rule using more objective measures rooted in financial risk. Do you support this initiative, and will we be seeing further rule changes at the Federal Reserve to achieve this goal?
So I like the sound of all that. I will say on issues of supervision, Vice Chair Bowman has significant authority, and also she's got the background and the understanding, and the first thing I would do is I would ask her what she thinks about that.
Just sort of a changing direction on a couple of questions. During the volatility in the Treasury markets last April, some have speculated that foreign investors were dumping Treasury securities. Since then, though, recent data has showed that foreign investors' holding of U.S. Treasuries held close to a record high in April. Does this data show that Treasury's safe haven status and the dollar's global reserve currency status remained strong while the administration conducted trade negotiations?
I would say yes to that. I think we need to be careful about these narratives that pop up quickly. I mean, we're the world's reserve currency and the world's greatest democracy, and I think the dollar is always going to be, for a long time, is going to be the reserve currency and the place where people want to be.
Let me ask you this. Do you believe there's a possibility that Treasury markets will crack, just as Jamie Dimon has recently warned at the Reagan National Economic Forum?
I don't want to say things like that. I don't think that's something that's happening. Treasury markets are functioning well and normally, and they did function through a period of pretty substantial stress. And as you pointed out, Mr. Moore, that they're focusing well now.
Thank you. With that, I yield back. And actually, if Ms. Salazar is still here, I'll give her my remaining time. If not, I yield back, Mr. Chair.
Gentleman yields back. The chair recognizes Ms. Williams of Georgia. You're recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you, Chairman Powell, for being here. It's been a while since I've had the opportunity to ask questions sitting at the bottom of the room, but I am happy to have this conversation today because the last time we talked last July, I mentioned that combating economic inequality is a critical part of the Fed's dual mandate, and that is something that I am deeply, deeply interested in. Back then, we were talking about how we can get everyone in our economy to have the opportunity to contribute to their fullest potential, because that's how we get our economy firing on all cylinders and work to continue to close the racial wealth gap, which my home city of Atlanta continues to lead the nation in. That seems like such a far cry from where we are today, almost a year later. Forget our economy firing on all cylinders. Now our economy and our nation seem to just be on fire. We're looking at tariffs that are raising the prices of groceries, fuel, housing, and everyday goods. Chairman Powell, I get feedback every time I'm in a hearing about my nails because I like to get my nails done. And my nail tech told me about the increase in cost of so many of the different products that would be used just for me to get my manicure monthly, because tariffs are frightening so many of our small businesses, which we know are the backbone of our economy, and so it's hurting my community in Atlanta. But it doesn't seem like our president and my Republican colleagues are really interested in making sure that our economy fires on all cylinders, as long as billionaires continue to get richer, because that's what we've seen and all of the gutting that has been done to the federal government. And Chairman Powell, I'm sure that this is coming to your department as well. With the recent events that we've seen, we know that it is very dangerous to gut the federal government, agencies that we depend on, and politicizing the work of agencies such as yours. Chairman Powell, this current president has tried to reclassify tens of thousands of non-political public servants just to make it easier to fire them. And that includes people who have served in Democratic and Republican administrations. It even includes people who serve in independent agencies just like yours. Chair Powell, as a chair who our current and previous president routinely has threatened to fire, I think I just heard something on CNN today while you were here testifying. But what effect has this policy had on the career civil servants in your agency? And are these threats making it easier or harder for the Fed to do monetary policy?
They're having no effect. We're doing our jobs.
You're doing your jobs. I appreciate you doing your job, even when it might not be easy. It is important to tune out the things that you hear on the media, because I hear it every day representing a district that has a lot of federal employees, a lot of people who work at your agency. I hear from people all the time. Thank you so much. And not only do I have thousands of federal employees in my district, but my district has one of the widest racial wealth gaps in the country. Much of that has to do with our worsening housing crisis. And unfortunately, as we've seen with the past 6 months, this administration has been focused on this big billionaire bailout bill, gutting HUD, and releasing a budget that does not help the supply of fair and affordable housing nationwide. Now we've heard the president talk about having the power to control interest rates. In your opinion, Chairman Powell, what would you expect the effects would be on the housing market if the president were to lower interest rates without addressing the housing supply crisis nationwide?
Sorry, if he were to what?
If the president has talked about having the power to control interest rates. In your opinion, what would you expect the effects would be on the housing market if the president were to lower interest rates without addressing the housing supply crisis nationwide?
Honestly, it's not our job to speculate on things the president might do.
So what impact do interest rates have on housing access?
Over the long run, they don't really affect housing supply. You know, assuming that rates will go up and down.
Well, not on the supply, but on the housing market. The supply is separate that we need to address going into this. If we're going to move interest rates up and down, that's not going to be the end-all, be-all to getting people into housing. We must address the housing supply crisis. But what impact do interest rates have on the housing market in general?
Well, interest rates really affect housing demand. So with lower rates, you see more demand, and higher rates, maybe less demand.
Thank you, Chairman Powell. I am out of time, but I have lots of questions that continue to work to close the racial wealth gap in this country, specifically focused on my district in Atlanta, where it is so prevalent. Thank you so much.
Gentlewoman's time has expired. The gentleman from Indiana, Mr. Stutzman, is recognized for 5 minutes.
Thank you, Mr. Chairman. And Chairman Powell, great to see you. And again, as I've mentioned to you before, I always appreciate your steady hand at the wheel and not, I guess, getting out of your lane necessarily, but obviously you have a huge impact on the economy and what's happening there at the Fed. I want to kind of follow up a little bit on housing, as I've been hearing a lot about housing concerns in Northeast Indiana, and I know you're not you're used to being beat up on a lot by folks all around the country, but I want to speak specifically to one particular individual, Grant Cardone. He made some pretty strong remarks about your policy when it comes to the housing industry, and he said, that's why you have 500,000 more homes listed than buyers for those homes. When the rates come down, prices will also come down with it, because you'll have more supply in the marketplace, and supply is what controls prices. He went on to say that interest rates do not control prices, and he explained that lower rates could stimulate activity in the market, and activity is what makes the economy work. And I agree with his comments, overall, but I believe, as you said earlier, the economy seems stable, and I would agree with that coming from an ag and manufacturing area. It's not booming yet, but I believe most people are optimistic that the good times are coming and that the structure is set and in place. But when it comes to housing, it seems like that's where a lot of Americans they're stuck. You know, they've had low rates, they've got a good mortgage rate, but if they want to make a move, they have to go out of that 3% interest rate into, 4.5%, 5% or higher percent interest rate. Thoughts on addressing housing, because their prices are up for sure, but there's no activity. The velocity is very slow. Would you like to comment on any of that?
Sure. We see the same thing you do in the housing market. It's tough. There's not people are locked in. They can't afford to get out of their house because the cost of getting to a higher mortgage, higher price mortgage would be a lot. So the best thing we can do, though, is to get inflation sustainably down to 2% and have it stay there over a long period of time. And that is really what we can offer to them. And I think, so if you go back to the beginning of the pandemic, when we cut to zero and we did all those programs, we really saved the housing industry because they're the front line for interest rates. At a time like this, when rates are, I would say modestly restrictive, not even moderately, but modestly restrictive, they feel it, and their customers feel it. We understand that, but we only have one tool for the whole economy, not just for housing. So it's something we consider, but we have to consider the bigger picture. And I do think in the medium term, as rates come down, you'll see normalization in housing. Of course, there'll still be a national housing shortage. I don't know about your district, but
yeah. No, there's a shortage.
Yeah.
I mean, considering the macroeconomics of interest rates, I mean, how much consideration do you take housing into that decision as you address interest rates?
We're always briefed on it. We always talk about it. We always look at it. But at the end of the day, it's the big U.S. economy, the whole aggregate thing that matters. We also talk about the agricultural economy a lot as well. But ultimately, and manufacturing, it's got to be the whole, and not any one particular piece.
Yeah, I just would mention it is hard for American families to make that move, and they're stuck. And so I would just highly consider ask you to consider that piece of it, because when Americans can't move and Americans can't upgrade or move laterally even, it really keeps the economy kind of holds the economy back a bit. When Americans don't have that. But again, I want to say thank you, because you have a tough job, but I haven't heard from anyone in my district asking interest rates to go up. So I'll just pass that along from Indiana's 3rd District. So with that, Mr. Chairman, I'll yield back.
Gentleman yields back. The chair now recognizes the gentleman from Colorado. Ms. Peterson is now recognized for 5 minutes.
Thank you, Mr. Chairman, and great to see you, Chair Powell. Thank you so much for being here today. I want to thank you for your long service to our country. I know that you've served under many Democrats, Republicans. You've always been nonpartisan and done your job to put our country first, and we appreciate your steadfast leadership. And if you are not reappointed, it will be very missed here. I have some concerns when I think about, I know you've touched on this a little bit through the questions today, but around the independence of the Federal Reserve. Your job, no matter what president you served under, Republican or Democrat, was to make sure that this was not a political position, while you brought news that some would not be happy about because it reflected what you had to do to address inflation. When I think about the conversations we've had going through the global pandemic and the economic fallout, and how we had to infuse money throughout our country to keep our services afloat, our businesses afloat. And while we suffered from inflation like the rest of the world, we had the quickest, strongest recovery. We were leading the globe. And so much of that was because of your leadership. And so when I think about what this position means, how important it is that there is independence, what are your biggest concerns about a potential successor that doesn't prioritize that and wants to do what is politically asked of them versus what they need to do for the country, and what are their long-term repercussions if you're not acting on addressing the economic uncertainties and trying to address inflation in this position?
So I wouldn't speculate on that, but I would say, the credibility of the Fed on price stability is very, very important. People believe that we will bring inflation back down to 2% over time. And once if they really do believe it and it's true, then that'll have big effects on not just short-term rates but long-term rates. If that were to be called into question, then you'd see long-term rates go up. I mean, that credibility once lost is very expensive to regain, is what the historical record says. So I just think I think people should understand that credibility on inflation is hard won and something we need to constantly tend. And that's what we're doing with our current policy, is just being careful with potential inflation risks. We haven't overreacted. In fact, we haven't reacted at all. But we're being a little bit careful about that set of questions as we decide what to do next.
And thank you for bringing that up. As we look at where we were, how far we had come in our economy, things were starting to stabilize, and we were starting to finally see a relief on the interest rates. They were starting to go down. Now they're holding steady. Can you talk about why the instability? When we look at tariffs around the increase in the deficit by the proposed big ugly bill that is being brought through Congress right now, and increasing our debt by trillions of dollars, and having our credit downgraded again because we are increasing our deficit. So with this economic uncertainty, where we were going, we were on the way down for reducing our rates, and now we have to hold steady to address the instability. Is that correct?
I'm sorry, could you just briefly restate your question? Yeah, I apologize.
Yes, I'm going to do this the best I can with with Sam here. That with our having to address inflation, as we've started to see it, you were able to decrease the rates. We were starting to go down a little bit. We were seeing that our economy was finally in a solid place. Prices were starting to go down. And now with the economic uncertainty, we're starting to see that you had to hold steady, whereas everyone was projecting before this administration came in with these changes that it was going to continue to go down. Can you talk about why you have had to choose to hold steady on the interest rates?
So we just, we stick to what we're assigned to do, which is maximum employment and price stability. We don't have opinions on fiscal policy or trade policy or immigration policy or any one of another, or regulation policy, other than that we have our regulatory responsibilities. And so we take what comes as it comes. And, elected politicians do what they do, and we don't criticize that. We don't have opinions about
Gentleman's time has expired, and the gentleladies.
Thank you, and thank you, Sam.
Chair now recognizes the gentlewoman from Texas, Mrs. De La Cruz, for 5 minutes.
Thank you so much, and thank you, Chair Powell, for being here with us today. I am Congresswoman Monica De La Cruz, and I am from deep South Texas, a largely Hispanic district, a rural community right there on the border of Texas and Mexico. I serve as the Vice Chair for Housing and Insurance Subcommittee, and it's difficult for families right now to afford a home on an average paycheck. I'm committed to finding affordable housing solutions for the people in my community, but also for all over the nation. So, Chair Powell, mortgage rates remain significantly elevated relative to Treasury yields, with spreads well above historical norms. To what extent does the Federal Reserve believe its balance sheet policy, particularly the runoff of MBS holdings, is contributing to this widening, and how does that factor into your broader assessment of financial conditions?
I don't think that our runoff of MBS is a particularly large contributor to that situation. I also think it's not just interest rates. It's so many things around housing now. It's insurance, it's materials, it's land acquisition, it's labor. There's so many cost pressures that are pushing up housing costs.
Thank you. With that being said, moving on to an entirely different topic, if the Federal Reserve focuses on issues outside its dual mandate, there are more opportunities for policy mistakes. How can you ensure that no other climate policy work is being done at the Federal Reserve?
So it is a big risk to our independence if we were to stray into areas where we shouldn't, that really aren't part of our mandate. And I would agree that climate is the biggest risk. So we really did the bare minimum. We did much less than I think people understand in the climate area. All we did was one piece of guidance, and then we ran one stress scenario, and by the way, didn't find anything. And I think you don't look to us to try to take on a bigger role or really to play any role in climate, which I personally think is an important issue and one that needs to be dealt with by elected officials. And for bank regulators just to step in and take that on without a mandate from Congress is not a good idea. It's not a good solution, and it's not a good way to remain independent.
Reclaiming my time, what kind of climate guidance did you make?
So for just the big banks, I believe, we asked them to monitor to have a framework for which they would monitor their risks from lending. That's all it was. And I would say that guidance is something we're looking at pulling back.
When you say the risk for lending based on political climate change, is that correct?
Well, the idea was that the changing climate could, I'm not defending this, I'm telling you what the idea was. The idea was, climate change would cause certain kinds of assets to lose value, and that if banks are lending to in those areas or to those industries, then they should at least be able to measure. It didn't ban anybody from doing anything, it wasn't prescriptive. At the same time, you have the feeling that the side effect of it would be to discourage lending, and we don't want that to be the case, so that's why we're looking at it.
Well, it does sound like that is policy that is based on political agenda. And when it comes to banking, it should not be based on political agenda, but instead on facts such as credit, facts as good monetary policy. So I would have to disagree with you on the fact that the Federal Reserve stayed outside of political agendas. When it comes to climate change, that is a political agenda, and I would have to disagree with you on that. Thank you. I yield back.
Gentlelady yields back. The chair now recognizes the gentleman from California, Mr. Sherman, who's also a ranking member of the Capital Markets Subcommittee, for 5 minutes.
We don't notice good bank regulation. Things just go smoothly. But in 2023, we saw the effects of inadequate bank regulation, where we lost 3 banks. There was a proposal that passed the House that would have cut the pay rate of your bank inspectors and regulators down to 70% of the rate paid at FDIC. So you would have been 70% of what the other major bank regulation agency did. I know you've announced things about headcount, but I'm focusing here on just the rate of pay. Fortunately, we were saved by not Superman, but Superwoman, Elizabeth McDonough, the Senate parliamentarian. But what effect would it have had on our ability to have good bank regulation if you had to go to all the folks in doing bank regulation at the Fed and say that their pay is going to be cut to 70% of the rate of pay over at the FDIC?
Would have made it harder for us to attract or to retain personnel. It also would have knocked down something we've had for 90 years, which is a sort of a moat that allows us to take care of HR issues on our own without Congress.
Gotcha. I've got a couple of questions I'd ask you to respond for in the record. The first is Section 899 of the big ugly bill, big beautiful bill, whatever you want to call it, enforcement of remedies against unfair foreign taxes. What this does is it imposes a tax on those residents of about 24 foreign countries should they invest in the United States, including in our treasuries. And we're trying to attract capital from abroad. This is to push out capital abroad. It doesn't affect China. It just affects 24 of our friends, particularly in Europe. The other thing I'd like you to respond for is the record is the tariffs and the effect that that has not only on the inflation rate, but therefore on interest rates. And at your press conference, you said increases in tariffs this year are likely to push up prices and weigh on economic activity. And I'd certainly like to know more about that. The Treasury has our reserves, but you also have a liquidity fund, which I believe involves buying and selling foreign currencies. And so that begs the question whether if you're allowed to buy the euro, whether you're allowed to buy cryptocurrencies. And of course, the president has said that some agency of the federal government should have a strategic crypto reserve. Do you or your successors have the legal right to take assets of the Fed and buy Bitcoin or Trump coin?
No, we don't, and we do not seek this authority.
I hope very much that your successor is not someone who tries to stretch existing statutes and come to an opposite answer. I'd like to focus a little bit on when you came before our committee last, I guess, in February. I asked you if you would take a holistic look at bank capital requirements, including the risk-based capital ratios like Basel III Endgame and stress testing, to make sure that you don't have a contraction in the ability to provide credit to Main Street businesses, and you said you would do that. So my question this time is, how does the Fed plan to sequence the various capital requirement reform proposals that we expect to see in the coming months? In what order will you proceed with reforms on Basel III weight risk capital, leverage ratio, stress testing, and the GSIB service charge, knowing that these have interactive effects? Can you tell us what the sequence will be?
So I really do. This is the heart of what the Vice Chair for Supervision is assigned to do, is to bring proposals to the board, and I read that as giving her she's the one who will decide that sequencing. You're right there. There are many things, and it's really up to her to decide what's the timing, what's the priority. And I don't actually know exactly what she's only been confirmed for a couple of weeks, so we're just getting going.
With you as the head of the agency, even if she is supposed to decide the sequencing, that your agency would tell us what the sequencing is going to be, and understand how important it is for people to know what the order those various regulations will have. And I yield back.
Gentleman yields back. The chair now recognizes the gentleman from Iowa, Mr. Nunn, for 5 minutes.
Well, thank you, Mr. Chairman, and thank you, Chairman Powell, for joining us again here. We have a saying, Iowa is nice, kind of boring. We want our Fed chairman to be just the same, and you're doing a great job at that. We appreciate it.
Thank you.
Nothing against boring. We like that, too. Look, you have a lot of great staff that come from Iowa as well. I appreciate you having them on your team. We also want to recognize the fact that, folks in Iowa are still feeling the challenges of the last 4 years. We're middle America. It is the heartland of the country, but it also means that impacts that change things on the coast don't always get felt the same way in the Midwest. And so as a result, folks are stretching every dollar as they face everything from higher grocery prices, eggs,